Buy or sell Church and Dwight. First off, read this disclaimer carefully. Then do your good deed of the day by liking and subscribing. So you can find the stock here under other themes. And in a theme I call hygiene, 9.88% and minus 36% here from the 52-week highs, so deep into bear market. Here are the stocks in the theme. Church and Dwight, they, among other things, they make cleaning products. It is the best performing, and it is closest to the 52-week highs. So here is the company's website: shampoo, Oragel, Vitafusion, OxyClean, Trojan, condoms, a bunch of different products that are kind of broadly in the hygiene theme. So here is the chart, weekly data points, and we have seen a very persistent rally. So it's been doing pretty darn strong. We see here that this one has actually performed very well, notwithstanding that we have had a breakdown in the market. What we also, however, see with this stock is that it is very common for it to actually have sell-offs. Like here, major correction. Here, major correction. Here, correction. Here, correction. So it's common for it to revisit longer-term moving averages. So it's good to go long at support, but at resistance, there could be some short opportunities, bearish. Looking at daily data points, it's been very strong, but there's also reason to suspect that maybe we are going to see some. The reason why we saw this strong rally on the 28th is due to this news. So the earnings tops estimates and sales rise. They expect to raise prices on 80% of its brands by February. And the thing is that initially you might think to yourself that, well, isn't that really bullish, that they can raise their prices? The thing is that the customer only has so much money that they can spend on stuff, okay? So when companies start to raise their prices, their access to that wallet will decrease. So this is very dangerous for these companies because they are obviously competing for the same wallet. So it's very much to be determined how that will play out. Yeah. Okay, so the thing is that the price here for the stock is at a very high level. It has a history of pulling back regularly. When we look here at the RSI level and look at what happened previously when we had the same RSI level, when we go back here, this RSI level literally formed the high before the sell-off. Yeah, when we go a bit further back here, this RSI level, same that we have now, it happened here. And if we measure, we did initially go a bit higher. Well, first we had a sell-off, then we go higher, and then we had a significant correction. So it was a good short. The previous time we had the same RSI level is back here on this day. And if you went short when you had that same RSI level, it was a very good short. So in the very recent history, this weekly RSI level has been a good time to initiate short positions, not long, not bullish. Looking at the distance from the purple 20-week moving average, the 50-week, blue 100, and the red 200-week moving average, it is at a very high level. The best risk-reward opportunity for bulls have been much lower. The MACD here is at an extreme level. So looking at the history for this stock, going back here to 1980, the RSI levels, the PPOs, but especially here the MACD, which shows momentum. It shows that the recent momentum to the upside has been ridiculous. It's been an anomaly. So we are very much due, quote-unquote, a pullback. Given that this is a large cap stocks, when mutual funds decide which stocks they are going to sell out of or buy into, they will definitively look at valuations. And looking at this stock, I think that given how quickly it has gone up, and given what usually tends to happen when it has these extreme rallies, I think there's an increased probability that fund managers will look at Church and Dwight and be like, well, maybe I should book some profit, and rotate into stocks that have recently been beaten up. Looking at the seasonality, January and February are mediocre over the last 10 years. Then it gets messy. All of a sudden, February and March are strong. April is weak. The last 20 years, then we see that February and March are strong. January, however, tends to be weak. So that's a messy thing here with the seasonality. So the seasonality supports a more bullish thesis. If we look here at Finviz, we do see that there is this diagonal trend line that has offered resistance many times in the past, and we are pretty close to it. When we look here at the price, well, we can actually go here to get that. So when we look here at the consensus estimates, then we see here that here 21 analysts are covering the stock, and the average price target is minus 7% below the stock price. The highest target is 16% above, while the lowest price target is minus 47, almost 48% below the current stock price. The analysts are typically overly bullish. That's a major critique of these price targets. The very fact that these big shot analysts cannot, in good conscience, sit down and write a report where they are like, whoa, go, go, go for Church and Dwight, we are going to the moon, which they usually do. It goes to show you how overvalued potentially this stock actually is, when even these pathologically bullish analysts think that it should go down. Sachs, they have a number 3 hold, but they do have C value and growth score, so the style scores here are good. The industry rank, however, is in the bottom 20% soap and cleaning materials. Market cap $24 billion, 1% dividend. When we go here to the insiders, let's load that. We see that we don't have any transactions here from this year, 2022, but here we had sell, buy, sell, buy, sell, buy, sell, buy, sell, buy. So almost like they have a method to it that they want to have like sell, buy, sell, buy, sell, buy. Because in insider activity, it does have an effect on the market. So it could truly be that here, okay? Which is shrewd, Okay, so here is the correlations. So 74% here with S&P 500, 81% with the XLP, which is the consumer staples ETF, and minus 37% with the 10-year yield, and minus 60% with the dollar index. Daily data points, 62% S&P, and 90% XLP, and 58% with the 10-year yield, and 80% positive here with the dollar index. So given the strong correlation with the XLP, we might as well look at what is happening here with the XLP, because what happens with the XLP is likely going to have an effect on Church and Dwight. Okay, so you can see here that the XLP, it is still holding up pretty strong here on the weeklies and also on the daily data points. So we haven't had anything close to the correction we have seen on other indexes like tech, XLV, major correction, on consumer discretionary, the XLI, much deeper of a pullback. So there is, an increased probability that the fund managers who have, they do have a nice profit on the XLP components, that they are going to sell out of them and move into some sectors that are more beaten down, just as, sector rotation. So to sum up, the technicals on Church and Dwight are more supportive of a bearish thesis. The seasonality, it is very bullish though. So the seasonality here is what really complicates this. But there is a possibility that given the super strength of February and March, it could be that those who look at seasonality bought early. So such that the strength we usually see in the coming months is already used up, so to speak. The fundamentals are clearly bearish. And looking at the correlations here with the ETF that is most likely to affect Church and Dwight, that one is, it wouldn't be a shock to see some pullback there as just a normal part of sector rotation. So there's more reasons to be bearish than bullish.